Scale VP, this is just a snapshot on our firm. So we focus on the scaling stage. And what I'm going to talk about this afternoon is kind of leading up into the scaling stage. So how do you know when you're ready to scale, which is not meant to be a pun on our name, but what we really look for is companies that have achieved product market fit and achieved a channel to market that is working, such that when we invest in them, companies take our money, they spend more than half of it on sales and marketing, and that has a really strong return, and the companies grow very fast. So they're typically doing a few $100,000 a month in revenue, and they typically more than double in the year after our investment because they have achieved that machine that can scale. But we're going to talk about the stage before that this afternoon. So first about scaling, when to scale, and then the second half of the talk will be about how to scale. And in both of these topics, I'm going to cover some of the more qualitative, softer issues. There's a whole lot of really great blog posts on things like the magic number, which is actually a concept our firm pioneered, and all kinds of metrics. But there are a lot of things that entrepreneurs need to know about themselves, their business partners, and their companies that are a little bit softer that help you assess whether you're ready to scale. So the when. Have you guys seen Startup Genome work or Startup Compass? Okay, so I advise everybody to glue yourself to this data set. It was started by a couple of researchers out of the Nordic countries. And what they did was built this giant data set of companies from the earliest stages. And where did they spend money? And what did they get in return? So what happened to their sales? What happened to their valuation based on where they spent the money? And this was, I think, the headline of their first report, which is the number one cause of startup failure is premature scaling. What they meant was people are spending money before spending money really pays off. Right? And so that's what I'm talking about. It's important to know when to scale. This is one of the first things that my partner said to me when I first started at Scale VP is essentially you have to stay alive to win. So make sure that you stay in business. You might have to lower your ambitions for a period of time while you're waiting to see, can you build a sustainable business and does it make sense to scale? So this is about waiting to being ready to scale such that you can keep alive. Okay. So what is premature scaling? Premature scaling is really useless spending. You're spending money on PR, you're hiring too many salespeople, you're spending too much on rent. Spending too much money means you're taking dilution, right? So either you're having to raise more capital than you would ideally like to, you're having to raise it at a lower price. The combination of those two things is twice as much dilution. And if you don't raise the extra capital, you're dead, right? So that's what premature scaling is. But being ready to scale is scaling and scaling spending to drive the top line or the user base, when you know that that the company's going to increase in value. So as investors, we spend a lot of time thinking about, is the money that we're going to invest going to yield a company that's more valuable by the next time they have to raise money, right? Everybody wants the up round. And at the earliest stages of the company, what you're really looking for is, can you attract the next round of capital? So if you've put your sweat equity into it, or you and your partners have invested small amount of seed capital, and you need to raise a seed round, what are the milestones you need to attract that, or you're looking for your Series A? So readiness to scale at any one of those stages is saying, if I add more fuel now, then I will achieve the milestones with a high degree of likelihood. I'm going to achieve the milestones that are going to let me get to the next level and the next fundraising. So that helps you, increase your valuation each time you raise money, which is the best way to run a cap table if you can. It also gives you a lot of downside protection because right now, we all know there's a ton of venture money, right? We invested more money in venture deals in Q1 of 2015 than we have in the last 15 years, right? We're at another high in the market. But money comes and goes, and you want to be certain that you can build your business whether the LPs decide they want to keep pouring money into this asset class or not. So to protect yourself, you want to really focus on being ready to scale. And this whole Series A crunch is very real. The vast majority of companies that raise seed funds never go on to raise a Series A. I mean, the estimates are as high as 90%. So the more you can be certain that you're going to achieve the milestones that will attract new capital or achieve profitability and customer fundedness, then the more you have your own destiny and control. Okay, so I said we'd talk about qualitative aspects of scaling. And really thinking about your own leadership readiness to scale is a little bit of a hard thing. I mean, we often don't really like to look in the mirror and assess ourselves that harshly because we have to pump ourselves up to be ready for the task of being an entrepreneur every day and you know, all the awesomeness and crushing it that happens in Silicon Valley. But it's also really worth it to be truthful with yourself about, you know, how much you still have to learn in order to truly crush it, right? Are you really good at recruiting? Is going to be one of your core tasks, because you're going to be trying to bring the most illustrious talent, the best technical talent, awesome marketers to your underfunded early stage idea that doesn't yet have proof points. Because that's just where you are. It's not, you know, those are not derogatory terms, they're just facts. So you have to be awesome at being a magnet for talent. You likely have co-founders, right? Because actually single founder teams very rarely get funded. They're just not as robust. So you need to have a founding team. But is the founding team aligned, right? Do the 2 or 3 or 4 people want the same thing out of this company? Are you all at the same stage in life where you can take the risk of jumping in, not taking a salary, working nearly round the clock on a startup? Or can you all say, we're going to work, you know, these hours and we have these other things that we have to do? So founder alignment is incredibly important, and founder lack of alignment causes a lot of companies to, I personally think that that's the source of a lot of the non-raising of Series A. Is not so much people wouldn't give them the money as the company just couldn't sustain the stress and the pressure of being in a startup. And then there's also the question of, are you ready to take some capital? If you're ready to take some capital, that means giving up some control, right? And are you ready to do that in order to have a chance to really flourish? Okay, a more quantitative thing, is your product ready to scale? Meaning, if you were going to take more orders or serve more customers or serve more web pages or app downloads or whatever the thing is that you're working on, you know, could you do it, right? Could you do it without scrambling, or could you do it without throwing a lot of bodies at it? So this is very important. We have a lot of birds of a feather events for our portfolio companies. So monthly marketer meetup and a quarterly get together for all of our CFOs. And last month we had Steve Pickle, who's the head of pipeline development at Salesforce.com, come and talk to our CFOs about scaling. And the thing that Steve said is, at every phase of scaling process, from the earliest phase, you have to prioritize process over people. And that doesn't mean, you know, replace people with robots, but it means even if people are going to do a task to scale your offering, it should be a documented, repeatable process so that you have a path towards more automation as you scale. So just being thoughtful about, if every customer engagement is a scramble, you're probably not ready to scale. But if you can do 1 this week, 2 the next week, 10 in a couple of months, then you're on a path to being ready to go. Okay, how many people know RJ Metrics? The company RJ Metrics. Okay, there's a company, an analytics company called RJ Metrics, who publish a really awesome blog on all kinds of analytics, and their product is really focused on cohort analysis. So it's one of the myriad different analytic tools that are out there. But if you think about almost everything you do in a startup as things in cohorts, and you want to say the cohorts are getting better over time, whether it's end users that you acquire and how long they stay engaged, whether they buy something from you or not, whether it's employees you bring on, salespeople is a great kind of metric that you have in cohorts. All those kinds of things that you bring on, you do it in a period of time, and you want to say the next time I do that group that happens in the next period of time, are we on average getting better? That's a really great sign. that you're ready to scale. And similarly, looking at your customers and thinking about them in that scalability sense. So NPS is Net Promoter Score. That's the number of customers who would recommend your product to somebody minus the numbers who are detractors who say they would not recommend. Really great measure of customer love, right? And they're all different kinds of metrics. This is one standard one. Do your customers love what you're selling them or giving to them? If yes, then you can do more of it. If no, then you probably really don't have product market fit. You might have sold something to someone, but you're not really going to be able to increase the volume over time. Are the customers churning? Are they making repeat purchases? And also, do you have a high gross margin when you sell something? So it's really easy to get high uptake on a product if you're taping $1 to it, right? I mean, and that is true. You see this in physical e-commerce companies where it looks like there's a high gross margin on the product, but when you take into account all the back office logistics and also the returns and the costs of the dead stock that doesn't get bought, you actually have a negative gross margin. Or you've got some kind of app that's monetized by partly giving away incentives and things. So if you're giving away something, yes, you can scale the top line, but you're not really scaling the business. And so looking for gross margin, it's a really great, very real metric that says people want to buy what I have to sell and they like the value add that I'm delivering. Okay, so now we're going to switch gears.
What do you, I hear on your past slide, what do you say to companies like Square, whose metrics suck? And they've sucked for 5 years, yet
they've had access to free capital.
Yeah.
But you'll see you'll see a lot of blog posts that hypothesize that it's not a sustainable business. I don't know. I mean, sometimes when capital is nearly free, as it has been, right? We're in some countries, it's a negative interest rate in Europe now, right? So there is a lot of money. This is what's driving all this money. I don't mean to talk like cap theory to a bunch of entrepreneurs, but because there's so much money, right now, people will fund low gross margin, high risk deals. But if you're starting a business now, I wouldn't pick that as a business to start because you're betting on access to that kind of capital for a long period of time. It may be true, but it may not. And so if it dries up, you're out of business. I mean, what happened, for example, in 99, capital was really cheap. In 2000, capital became very expensive. The e-commerce space didn't dry up because consumers stopped buying things on the web, right? That didn't happen at all. What happened was the cost of capital got a lot higher and the cost of starting and scaling businesses was dramatically more expensive in Internet 1.0 because we're all buying Sun, these are going to be words that most of you don't even remember, but we're buying Sun Spark stations for $50,000 a piece and big EMC hardware boxes for $500,000 a piece and renting data centers and stuff. And so the cost of scaling was really high. And Amazon was the first to IPO and the first really to do an enormous secondary offering. They scooped up a bunch of capital. Then Amazon said, the market's going to hell in a handbasket. You investors shouldn't invest in this space anymore. And they stopped backing newly public companies. And so other e-commerce companies that needed access to capital didn't get it, and a whole bunch of them went out of business. So
you're suggesting the rug is going to get pulled out from underneath Square?
I don't know. I'm not an investor in Square. I wouldn't dare to opine on Square. I'm just saying, if you want to be, the more you want to be able to scale and be in control of your own destiny, don't build a business that relies on other people's money at a really, really low price. Yeah.
So I found it interesting that you, in the previous slide, you were focusing on making sure that there's low churn and that there's really strong engagement, which is mostly driven by product enhancements and
Yeah.
by focusing on product. But you guys invest heavily on the marketing side and the sales side, or that's at least where you would like a lot of money to go. So, so how do you kind of gauge when you think a company has the right amount of churn or the right amount of engagement, that it makes sense to shift focus to marketing and sales and customer acquisition?
Yeah, no, that's a really great question, and actually you'll see in the upcoming slides there's a lot of emphasis on product as well as on the marketing side. But well, the way we think about it is it's not really useful to spend a lot of money on sales and marketing until the customers love the product, right? I mean, which might still mean that there are tons of feature additions to add and lots of stuff to automate, right? Because the early, early versions of the product, you're going to have, integration issues or whatever. I mean, this is more true in B2B, but it's also true in consumer-facing businesses. So, if you have a business where you have high churn, whether it's a mobile app and the customers use it, you have a high monthly average uniques, but your dailies fall down, and every month you have to acquire new customers. You're churning your business, and even if you have a business that has a subscription business model, whether again consumer facing or business facing, but you have high churn, you really have a transactional business model where people might pay you for a couple of months and then they're gone again. So you just, every month you're pushing a rock up the hill trying to make the top, you're trying to make the top line go up while the customers are leaving. You have to replace the old customers and acquire new customers. That just means either it's a bad business, shouldn't scale, you haven't got out of the when yet, or it couldn't be a good business, but it's not ready to scale yet. And so achieving the product love part with low churn, good gross margins means now's the time to spend more on sales and marketing because we're going to be able to get the value out of it. Does that make sense? Okay. So now we're going to talk about the how. So first of all, the qualitative stuff again, which I just can't underscore how important your own psychic self-worth and stability is. I had this cartoon was actually emailed to me by a really early stage entrepreneur who is a friend of mine. He has some pretty dramatic emotional ups and downs. And I told him that I was making this presentation, and he just sent me an email with this. It's like every day, and here's the thing, every day you have to be something different because you've got to be the tech person and the salesperson and go out and raise money. And so you're just pushing the button like every time, like make me into this. And similarly, stepping back a little bit, you often hear people ask the question, what's harder going from 0 to 1, 1 to 10, 10 to 100. Every one of those phases is hard. And every one of those phases requires different set of talent. And the really awesome entrepreneurs have that and have that ability to do the reinvention. I mean, so we have had over the course of the last 15 years, many times the youngest public company CEO in our portfolio. Aaron Levy at Box is one of our CEOs, one of our companies. We funded Box in the middle of the year. They did $4 million in revenue, and they'll do something like $300 million this year, right? Over and over again, we're seeing young entrepreneurs able to scale, but it requires an awful lot of self-education and a focus on yourself and investing in yourself and learning from peers who've gone ahead of you, learning from all this incredible content that's on the web, coming to conferences, probably not me, but there's a lot of reinvention that's involved and continued investment in yourself as an entrepreneur in order to be able to scale. Okay, this is going to get a little bit to the question about product and sales. So this is a concept, the tooth to tail ratio, that a consultant who worked for me when I was an executive at Adobe Systems taught me, which is an Army term, which says you really want to mass your power in the front. You want to spend your money on the things that are going to make a difference and spend less money on all the back-facing stuff that's supporting. And so what does that mean for a startup? If it's revenue generating or it's product innovation, spend money on it. If it's ping pong and peanuts, don't spend money on it. And so this is where you're investing in product, you're investing in the engineering, in sales and marketing, in building your pipeline of talent and building your pipeline of investors. All of those are forward-facing areas where you need to make investments. It doesn't mean you don't have to do the things that are on the back end, and particularly this, back office, back ops, and DevOps. Back ops actually being a company name, but really, shorthand for all your CFO functions and things like that. They're incredibly important, but on a ratio perspective, you'd prefer to spend more on the forward-facing things. Okay. And again with the talent thing. So CEO, one of those things you have to transmogrify yourself into is you're just always recruiting, right? You're always attracting talent. So those are the two big jobs when a board is evaluating a CEO. We're always looking at, does he or she do a great job attracting capital to the company and attracting talent to the company, right? Because very few people report to the CEO. The people in the company report to the next layer down. In fact, the next layer down is the company scale. So can the CEO attract people who continue to attract good people? Similarly, is the CEO fairly ruthless about getting rid of repellers as fast as possible? So we all make hiring mistakes. And sometimes you just don't know. But the people who you bring in who can't attract talent or or in fact drive away the other good people in the company, you just need to cut your losses and get rid of them faster. This whole part, the learning how to assess talent and caring about your culture is also really important. And I'm going to tell you about another resource here, another blogger is Dharmesh Shah, who's the co-founder of HubSpot, which is another of our portfolio companies. It's based in Boston. So Dharmesh spends a ton of time writing about the culture code at HubSpot. He's taken a lot of the aspects from the Netflix culture code, but made it their own. And in fact, one of the things that they emphasize a lot at HubSpot is CHI, which is the Customer Happiness Index, which they use to help drive down churn in the business as they were scaling. But it's really worth it to think a lot about the culture of your company. I spent a couple hours with one of my CEOs earlier this week, and it's a very mature company. But and we were talking about the culture. They have a company culture that's codified, that they decided, in some brainstorming offsite, but they don't use that language when they're talking amongst each other. And so when there's an issue, and when they have one department that's not holding up its end of the bargain right now, and it can come across as the CEO, ripping the VP of XYZ in an exec staff meeting. And what I told the CEOs, if you went back to your company culture that says we respect each other and we're supportive of each other, you can use that kind of language in a meeting and say, hey, this is the way we are at this company. We don't let our peers down. We're partners to each other. And it takes a lot of the pressure off of the CEO because it's the way we are as people. And that's really what the culture is how are we as people? What are we as a company? And I think for CEOs, there's so much burden to be the single point of making a lot of decisions and carrying a lot of burdens that when you have a culture that that enables that kind of directness, it allows you to sort of spread the burden a little bit and all carry it together. It becomes much lighter. On the last point, the tail, right? And saying on a ratio basis you want to minimize the tail. Hiring a really great person to manage the back ops of the company can be a huge enabler for the founding team and for the CEO. And it could be that one of the founders plays that role. That's true at Box, where Dylan, the CFO, is co-founder and just as young as Aaron. But a lot of the process invention that allows you to scale actually happens in the back office, right? Whether it's implementing e-signatures for sales and the whole recruiting process, and training and all of that is often driven out of the HR and CFO's office. So having somebody there who's really awesome is incredibly important and can be a great partner. Just to illustrate how important talent is, this is a handful of our portfolio companies with their headcount trended over time. It's just illustrative. But you're looking at hiring hundreds of people when you're scaling, hundreds and hundreds of people, right? And this is this is net employee growth, right? So this is the actual headcount, so it doesn't take into account the people who came and went during the period. So getting good at hiring, getting good at ramping people's capabilities is incredibly important. So I would urge you to really focus on that as part of your getting ready to scale. Okay, product. We talked about this a little bit earlier. Product is never done, right? I mean, there does become a point when you become HP, when the innovators will come in and disrupt you from below. But as a startup, your job on product is never done. And so you're always having to push on making investments in features, in quality, so you have that net promoter score so that people love your product. In analytics, so often now the thing that customers are paying for is the analytics. You're giving away some kind of feature, right? You're giving away storage or file sharing or something, but what I'm providing to the IT person who wants to manage and control the use of it is who's using it, how much is using it. When I fire an employee, I get to take it away from them. Think of those kind of features as analytics. Or I'm giving away music, I'm giving away web content, but what I'm providing to my advertising partners is a really detailed look at who is on the site, who's engaging with their media, et cetera. Similarly, I, as a company, as an entrepreneur, need to have analytics about my business. So that is a never-ending part of investment. And then all the retention and upsell aspects. So that becomes sort of a cycle along with the features and trying to figure out exactly how you slice and dice your product over time such that you're kind of capturing that what's called the consumer surplus, right? Some people are willing to pay a little, you get the right pricing and packaging for them. Some people are willing to pay a lot, you give them the right feature set. And that's just a natural maturation. It doesn't, from the get-go, you come out of the gate with one thing, then you've got the gold, silver, bronze. Please don't deviate into really fancy names. Just stick with those tried and true. And what's really cool now, as I said, in my era, we had to spend literally, it was $12 million per new cluster to scale our first SaaS company. Now you can rent everything, by the bit. And so all these kinds of developer ops, DevOps solutions, this is actually a really big investment area for Scale Venture Partners. Some of these companies are ours. It's really great because you've got a platform. You don't have to build all that infrastructure technology. You can really focus on the things that are above. Okay, marketing. We're going to talk about marketing and then sales. So marketing is always a process of balance of where you're going to spend. And what you really want to do is operate. So Pareto is the person who basically came up with the idea of the 80-20 rule, right? You want to do 20% of the effort for 80% of the benefit and then tail off from there. And you see the most awesome bootstrapped companies that don't spend venture money do it in a way of every day optimizing what their marketing spend is, right? So you can drive so much volume out of free, but you can only get so much volume out of free. You can't pulse SEO or App Store reviews. You can only get the natural traffic from that. So then you've got to do whatever the next cheapest thing is until you run out of that volume. Then do the next cheapest thing, or the next most expensive thing until you run out of that volume. So like there was this company called Big Fish Games that was just acquired for $800 million last year. It was a web game company kind of before the mobile games business. And that entrepreneur bootstrapped the business by every day re-racking his marketing spend and taking whatever margin he had made the prior day and investing it the next day in the next day's marketing spend, and then just kind of like building up from there. So if you have that kind of mentality and you've invested in the analytics that'll give you that, then you can increase the velocity and volume without mass marketing in a way that's extremely expensive. Okay, sales. This is a clip from Glengarry Glen Ross, who has the good leads and the always be closing. one of the startups I worked in, the CFO had a mug on his desk that said, "Nothing happens till somebody sells something." And that really struck me because, so I was a smart kid in school. I did engineering. I thought smart people went into engineering and the jocks went into sales. And then, yeah, I was really dumb. Later in life, I became a jock too. A jock and a salesperson. And as I got more senior in business, I realized that actually everything, the more senior you get, the more everything is about selling. You're selling investors on your idea, you're selling executives on your company who you're trying to get to join, you're selling customers on your product. Everything is about selling. So I really had to go back to school and unlearn the stupid engineering stuff I had learned. So that's my exhortation to you, is always think in sales mode, right? And which doesn't mean, so really good selling, strategic selling is much more listening than it is talking, right? But it's still selling because you're listening for what is the customer need, what is the executive's need to, what is going to motivate him or her to join your business. But you're thinking in sales mode. And it's really important to get the customers to give you money. So I'll tell you another anecdote. We had a company a while ago that it was storage management software. We hired, so it was started by 4 engineers. None of them wanted to be CEO. So we hired in a fellow who had been a business development executive at EMC, really talented individual. He rejiggered the whole sort of pricing and packaging. And Gartner loved us. We were the top of the quadrant, but we weren't making revenue. I had a meeting with this fellow, and I was asking him about that quarter's sales, because your investors do that. And he goes, "Sharon, you're so negative. Why don't you take a balanced scorecard approach to assessing the company and look at all the other things that are so good? You're just looking at revenue." And I'm like, "Michael, I do take a balanced scorecard approach. I just weight revenue 90% and everything else 10%. Because when the customer pays us for our software, we know they really need it and they really like it. And when Gartner puts us in the top of the Magic Quadrant, we know that we have paid them to do a consulting project for us. So, when the customers pay you, then you really know. And especially, and this is one of the other key marks is if you have if your accounts receivable are aging and the customers have bought your product but they're not paying for it, go and look at those product quality things and make sure that they're marked. So getting actual money from the customer is a way better hotness than anything TechCrunch will ever say about you. Okay. On the front of sales, it's that always be closing. You're always trying to hire sales talent. You have to have a pipeline. It's, as I said before, it's one of those sectors where you really are looking to hire people in cohorts. If you can, as soon as you have access to capital, there's a golden rule of trying to hire salespeople in groups of 3. So because one of them is going to wash out, and you want to have enough data of what worked with that little group that you can try and do that again the next time, or avoid whatever didn't work in the prior time. And then this, the focusing on sales enablement and that's really what Steve Pickle was talking about when he said invest in process, right? He's not saying invest in robots. He's saying invest in making the sales process repeatable. Give your salespeople scripts that work, let them, try and close, give them pricing and packaging that works, and be prepared to iterate. That's the whole A/B testing. You're A/B testing your sales scripts just as you are your website. This last point about sales leadership is really to say in the early days of scaling your business, the salespeople are going to report to the CEO, right? You don't say, I have to grow sales. The first thing I'm going to do is hire a VP of sales who will go hire people. In the early days of companies' growth, the entrepreneurs making those early evangelical sales, and when you have just enough margin from those early sales, you hire a couple of salespeople underneath you, and that's where you're trying to iterate and figure things out. And it's when you're ready to scale is when you hire a VP of sales. And it's true with our portfolio. I would say most of the companies we've invested in the last 18 months, it's an entrepreneur, 3 or 4 salespeople, and one of the first things they spend our money on is a VP of sales. Okay, and the last point is another one of those sales tactics, which is scaling your capital base. So scaling your capital base is very much like scaling the revenue of the business, in that it's really important to understand who your target is. So looking at companies that are comparable to yours, companies that have served similar kind of markets and been successful, and who have been their investors along their life cycle. And don't go to TPG, who's a late stage crossover fund, for your seed round of capital. And similarly, a $5 or $10 million fund is not going to lead your late stage round. You're really looking to match the size of fund with the size of your fundraising, and the right sector to the business that you operate in. And then secondly, we focus a lot, even when we're building our funds, is the notion of friend raising before fundraising. So when you have that line of sight to who might be your next investors in your next round, you're going to see them before you're quite ready for them. But you might go to them and say, I know we're not quite ready for you yet, but I'd like to tell you a little bit about my company. I think you're right. You will become right, or we will become right for you. Because we're in this sector that I've seen you operate in successfully before. Can I come and get some feedback from you? And so you're really trying to see then, where do you get resonance on your offering, your style, and the investor, so that when it's time to raise the next round, you have a really good sense for who might be a likely suspect. And then this is the end. Scaling ABCs, it's really that always be closing mantra again. It's really about yourself, investing in yourself, building your own talent, and then turning that into the company and building the talent, the product, and your capital base. Thank you.